This is Straight Up Mortgage with Madi, and today we are going to be discussing rate and term versus cash out refinances. I hope everybody is having a wonderful holiday season. Happy holidays from my family to yours, and let's just jump into it. So, we have two types of refinances, or two main types, two conventional types that we see frequently when we are processing loans as loan processors, right? So, we see the cash out refinance, and we also see the rate and term refinance. Now, I remember some years back, I was talking to my mom about refinancing, and she was like, "No, I don't want to refinance because one of my friends told me if you refinance, that means they're going to start the 30 years all over again, and I don't want to do that." And blah, blah. So, when you're not aware or when you're not knowledgeable about the programs that are available to us as homeowners, then we can kind of mix, you know, things up. So I have come to clarify the difference between the cash out refinance and the rate and term refinance, as well as why would a person want a cash out? Why would a person want a rate and term? Um, it's important for you to know generally as a homeowner, but then it's also very important if you're processing mortgages to understand the difference between the two. Because for me personally, when I first started, I did not understand. Nobody explained it to me. I just had to kind of figure it out as I went along, right? Okay. So we're going to start with the rate and term refinance. So, of course, the first reason why a person would want to get a rate and term refinance is to take advantage of a better rate or a better term. And when I say a better term, it could just be a better term for them in their individual financial portfolio. But let me explain. So let's say an individual purchased a home with uh, a 5% rate, excuse me. So let's say an individual purchased a home at a 5% interest rate, and now it's been, I don't know, 3 years later, and rates are down to 2.75. And now, if this borrower were to refinance from that 5% interest rate to this 2.75% interest rate, they could potentially save some money, right? Let's just put a dollar amount on it and say they could save $400 a month. That's a good chunk of change, right? That you could save just because you refinanced. Even in the event you had to bring some money to the closing table, it should, the rate of the loan and what you'll be paying monthly for the rest of, or for the duration of your loan term, is going to be significantly less. So you will be able to save some money in the long term. So that's a reason why an individual would do a rate and term refinance to get a better rate on a said property. So term, right? We know we have 15-year, 20-year, 30-year is what's typical. But let's just say maybe when you purchased the house, you had a 30-year term. But then now, let's say maybe it's 3 years later. I'll use the same 3 years later, and you have a better position. You're making more money, and you would, potentially like to pay off your mortgage a lot sooner. So maybe you have 27 years left with paying your current mortgage, but you're like, I want to shorten my term. I want to make this a 15-year. So yes, your payment per month is going to be significantly higher because, now we're going over 15 years versus over 27 years. However, that might be better for you in your situation because you're like, yeah, I'm going to be paying way more money than I'm paying a month now, but I can afford it and I want to get my mortgage paid off as soon as possible. So rate versus term with a refinance, these are reasons why people would go the route of getting a rate and term refinance. Now, As a processor, something to keep in mind is the borrower can get back money with a rate and term refinance. However, uh, it cannot exceed 2% or $2,000 at the closing table. This is conventional Fannie Freddie guideline, whichever is less. Now, you know, this is based off the amount of available equity. When I first got into the banking industry, period, I remember I worked this job at the credit union and they had home equity lines of credits. And I was just so confused as to what it is that was happening. And they're like, oh, they're borrowing money against their home. They're doing what? So hopefully we do have the understanding of what equity is, right? So maybe you have a mortgage on your house and the mortgage balance is $100,000, but your house is worth $500,000. That $400,000 difference is the equity that you have in your house. So it's the amount that you have to borrow from. With rate and term refinances, typically that's going to be 80% loan to value, so the loan amount to the value of the property. And with rate and term refinances, you cannot use it to pay off outside debt. This, especially as a processor, you need to know this. So let's just say we use the rate and term to pay off the current mortgage. That's what it's for. And now maybe in order for the borrower to qualify, we're like, dang, let's see, our DTI is tight. Maybe if we pay off this credit card, as soon as you pay off another debt other than a mortgage on a rate and term refinance, it is now considered a cash out refinance. So you cannot utilize the rate and term refinance to pay off any outside debt. The only debt that can be paid off in a rate and term refinance, again, is that current mortgage. Documents needed for a rate and term refinance. Read your DU findings because what is needed is going to be outlined there crystal clear. Most of our issues as processors, as underwriters, is not wanting to read the DU. And I get it, it can be overwhelming, especially if you're not used to reading it. But the more that you read your DU, the more acclimated that your eyes will get to it, the more aesthetic it will become to you, and you'll know what to look for. So, maybe the first 5 loans of reading your DU, your head hurt. But after that, you're going to know what to look for, know what parts of the findings need to actually be read to know what documents are needed. Because each section is outlined, right? Your credit, your income, your assets, and your DU is going to outline what is needed from the borrower processor, in order for the loan to be approved, because that's what underwriting is going to end up conditioning for anyway. One thing I do want to note is something I do every time I come into a file is I go to my details of transaction and see whether or not a borrower is bringing money to closing or getting money back at the closing table. Now, if the borrower is getting money at the closing table, we will not need assets. So like in this example where I'm saying that the borrower can get up to $2,000 at the closing table for a rate and term refinance, if we check the details of transaction and they are receiving money back, then we're not going to need assets. It's when we're bringing money to the table that we're going to require assets to be documented on an application and in the file. I do have to add a caveat though, because if it's an investment property, we'll need to show reserves. But if we're talking about primary residence, for a rate and term refi, even for a cash out refinance, we may not need assets if the borrower is bringing money to closing. Now, if you are getting an approved ineligible and you have assets, you might want to plug those assets in because you can get a better recommendation just because the borrower has reserves documented in the file. Okay, so the cash out refinance, we went over the rate and term. Now we're going to focus on the refinance. And just as it is saying cash out, that's exactly what we're doing. We are cashing out money from our home. And this again is based off of the equity that we have available in our home. So I just want to talk about quick reasons why people would want to cash out money, right? If you have the available equity, meaning either, let's say you don't have a mortgage on the property, so all you have is equity, you can borrow against the value of your property. Let's say if you do have a mortgage, but it's a smaller one. You have $100,000 left on your mortgage, but your property is worth $600,000. All that $500,000 wiggle room that you have within there, that's money that you can take out of your property. Why would you want to do that? Many reasons, right? Maybe you want to start a business. Maybe you want to pay off your child's tuition. Maybe you want to consolidate some payments. You know, this is like basically you can borrow money from against your property for whatever you may need it for, which, as you can hear, is really different from the rate and term refinance, right? So these are two different reasons, two different purposes as to why you would want to refinance your property. So as you can hear, it is going to be a riskier loan type, right? This is cash money that's being withdrawn from your property. That's going to be borrowed to you from a lender. And, this is not just money that is held against the property. This is cash money that's being offered to you, which would make it way more risky. So the rates are going to be a little bit higher. The credit score requirement is going to be a little bit tighter. You can go up to an 80% LTV as well with a cash out refinance. I explained how it is based off of the amount of available equity. So, if your property is worth $500,000 and you already have a mortgage on that property for $400,000, you don't have that much wiggle room, to borrow against. So this is probably not going to be the best option for you, or a option for you. Like I said, with a rate and term refinance, you cannot, pay off another. You can't pay off another debt with money from the rate and term. If you wanted to do that, that loan would now have to be considered a cash out. Because in this case, like I have here, for a cash out refinance, you can utilize it to pay off outside debt. Again, for the documents that you need, read your DU findings. Your DU finding is going to, outline everything that's needed for your cash out refinance. Here is another example as to how, assets may not be needed, because this is way more money that you can cash out than with a rate and term. So if you are getting $300,000 at the closing table, unless this is an investment property where we like to see reserves, you're not going to need any assets. So you're not going to have bank statements on file. A little bit of a rewind. I use the word reserves. I do not want to assume that you know the meaning of reserves. So I'm just going to break it down really quick. Reserves is how many mortgage payments you have in your bank account. So it's basically the total amount of money you have in your bank account divided by your mortgage payment, so that way we can come to the amount of months of payments you have in your bank account. If you need reserves, then you do have to document your assets or your bank statements. If you don't need reserves, and you're cashing out money, then you're not going to need assets. So hopefully that gave you a little bit of an understanding as to what reserves are, and documentation requirements when we need to have assets. I always look at my cash to close. Okay, so remember that. Look at your cash to close to see if you actually need the bank statements. and then also your program, because you need to make sure it's just maybe a rate and term where the borrower is getting cash back, um, the cash out refinance, of a primary residence, that the borrower is getting money. But then let's say you're getting an approved ineligible. You may want to also add the assets in, because when you add assets in, if you're getting an approved ineligible, um, reserves is something that DU likes to see, and you could get a better recommendation. So maybe that approved ineligible can now turn into an approved eligible, based off of the reserves that you have documented both on your application and in your file. So yes, I hope you have a better understanding as to the difference between rate and term refinance and a cash out refinance, because they're two totally different purposes, and they're very popular. If you're processing mortgages, you're processing refinances, you're processing rate and terms, you're processing cash out refinances as well. Well, thank you for watching this video. I hope that it was helpful to you. Please like and subscribe to my YouTube channel. I am doing my best to really start to be consistent and give you the content that you are asking for. Utilize the comments to let me know things that you want me to touch on, things that you would like me to talk about. I will be happy to do that. I hope everyone is enjoying their holiday. Happy New Year to you. Happy Kwanzaa. Happy holidays. And I will see you on the next video.